Okay, 7:30 on the dot. Hopefully you can all hear me, and I can still see a few people logging in. But welcome. My name's Campbell Venning, and I am going to be one of your hosts for the night. Just a few housekeeping issues. Just want to make sure that people can hear me, and if somebody could please write into the Q&A or in the message box, in the chat box, just to let me know that you can hear me. That'd be wonderful, please. Thanks, Pete. Look at that. I've got a few people. Richard, good on you. Thank you, everybody. You can hear me nice and loud and clearly. So I am not going to muck around tonight because we are famous for going over time. So without further ado, we're going to get into it. So quick agenda. We are going to go and talk about who we are and what we do and how we may be able to help you with your investing. I'm going to give you a property market update for New Zealand and the sort of the hotspots and locations. I'm going to talk about really simple portfolio strategy in that you, as an investor, whether you're starting out or a seasoned investor, it's property 101 for want of a better word. We're going to look at some reality checks of the market and where we're at with the different locations and why some locations are a better time to buy than others. I'm going to go through some of the case studies that we've done before and how we work as a business in terms of our pipeline of deals coming through and the next steps if you're interested in working with us. So some of you may have seen me or heard me before, but just a quick synopsis of me. That's me there on the right, the blue shirt, and my whānau and my tribe. In fact, the only difference here is that we've got a different dog on the right. So I'm a typical guy who fortunately and luckily enough got into real estate very, very early, and it's pretty much changed our life in a good way. It's enabled us to do some pretty impressive things, and yeah, property has been in our world since 1992. That's when I bought my first property, and for 10 years we did nothing but renovate. So I was a serial investor. I didn't sell anything. Hadn't read Rich Dad Poor Dad. I hadn't read Robert Kiyosaki, Dolph Tarous. None of these people existed back then. So we kind of just found our way into property. We've bought the worst house in the best street for 10 years, 2 to 3 a year, and amassed a pretty decent portfolio. So I've been in the industry for 27 years. I've renovated over 25 years, and that first 10 years was just nothing but renovating. I've been trading and investing for 15 years in terms of side by side. I had 3 years as a developer. And I also, and this is so critical, when you get involved with us, a lot of what we do is very numbers based, and property is all about the numbers. It is not a race. It's not a competition. It's all about matching the numbers to your financial circumstance. And I learned that very early. I learned that in my 20s because I worked for a very, very seasoned money guy who he worked for Citibank when they introduced revolving credit facilities into New Zealand in the 90s. And he taught me investment lending. So I was trained by the best, and I now, I guess I instill that information or that knowledge into our customers. I've been involved in the real estate agency world for 7 years, and I can put my hand on my heart and say I've never worked for a Bailey's or a Harcourts or a Barfoot's or any of the main brands. I've only ever owned my own real estate companies. Right now, we've got 3 real estate agencies. And the main one that we're working on that you're here for tonight is the Property Factory, and that's a listing agency. We'll talk a bit more about that in a minute. I'm also a seasoned trader. I buy and sell property all the time. I'm investing, and I've got 6 properties that we're building in Wanaka next year, but we're doing all the planning for it now. I've got a build going on in the Wairarapa. We've just bought a new house in Christchurch. We've sold our house in the Wairarapa. And I've got a bit going on in Christchurch as well with existing rentals and ones that we're looking at acquiring at the moment. So I'm a busy, active, hands-on property guy. And anybody can do what I've done. I guess I've got 27 years of doing it as a professional, I guess. I stopped my day job 19 years ago. I started working for myself. And I guess I'm a walking, talking expert or a proof of what you can do And I guess I've touched every part of property, so I guess I'm labelled as an expert. I don't really like the title, but I guess there's not much I haven't seen. I've been through 4 property cycles, and it's just my bread and butter. My wife gets sick of it on holidays because I can't stop looking at property, but I love it. I'm passionate about it, and I'm really desperate for the next 10 years to get more people into it because it's getting harder from a knowledge perspective, and I think it's going to get harder from a competition perspective, and I'll talk about that later. I also used to write a monthly article in the National Property Investor magazine, and we might start doing that again, but it is time consuming, but I enjoyed that. That was good fun. Did that for a few years. And I guess now the current focus with the business is called the Property Factory. And the Property Factory is what I call a wholesale listing agency. And what that means is that we match buyers, investors, first home buyers with the right property. And we don't do it on Trade Me, we don't do it on real estate.co.nz, we don't do it in the property press. We do it through database marketing, we do it through relationships that we've had for a long time. And developers and builders love us because at the beginning of a development, when they need sales, they don't want them, they need them. At that point in the process, we get some cracking deals, and I've got one tonight that we'll show you later. So we've been doing this for a long time. I'm over 2,100 properties now that I've sourced and sold on behalf of builders and developers. And we're over, I think we must be over $1 billion now. That was put in there about 3 months ago, so we have to be over $1 billion now. And I guess with our team, if I look at our combined team, we've got over 50 years real estate acquisition, development, and investment experience. So I kind of, I don't like beating my chest or banging the drums, but I guess we do know what we're doing, and we're not just theorists, we're not just educators, we actually are doers. I can't remember a time that I didn't have some kind of property activity going on. So yeah, excuse me, that is a little bit about me and our business. And if you haven't heard from me or about me before, if anything, I try I understate things. But like I said, there's not much I haven't seen in property. And over the last few months, we've started working with clients again. I've had the last 2.5 years off focusing on my own property. I've had, we're up to about 38 or 40 houses now in Wanaka, with the next 6 sort of being planned at the moment. We did another 15 in Queenstown. So we've been pretty busy on our own stuff, but I decided to come back out and get more involved in it on a business capacity. So the Property Factory is that business, and I'll be surprised if it can't help you, or we can't help you once you know what we do. And hopefully tonight I can help you understand that. So that's me, that's us. So 20th century investing, or 21st century investing. We have had a real paradigm shift. In my first 10 years, I did not do anything but second-hand property. I didn't know anyone that did any new property. In fact, in 1992, the cost of building was just, that's what rich people did. Investors bought second-hand older properties. They converted old villas from student flats into executive accommodation, and that was our focus in Wellington. For that 10 years, we went and bought student flats, Worst House, Best Street, and converted them to executive accommodation. But they were still single glazed 1920s, 1930s villas. But the reality is property has a lifespan. And if I look through the New Zealand stock of real estate, we are very old. We are tired, and we are massively in need of an upgrade. And it's one of the reasons that the banks only lend 70% on older properties. It's one of the reasons that they're now smashing landlords with healthy home standards, insulation, compliance, etc., etc. The world's changing as well. People are downsizing. They're going from big old villas, bungalows to townhouses and apartments. And that's an international trend. And in the old days, we would spend $1 on our renos, on our renovations, and get about 3 back. Now the sort of expectation is you spend $1 and you get 80 cents back. It's just not economical to renovate anymore, or it's very hard to. So we're in a paradigm shift where new stock actually makes a heck of a lot more sense than old stock. And we've got a couple of deals at the moment where it's cheaper to buy new than old, which is just crazy. Imagine walking into a car yard and the sales guy or girl says, oh yeah, here's a 1999 Corolla. You can have 20 grand, or you can have a new one for 15. I mean, who would buy the old one? But I think people are creatures of habit, and they kid themselves on the cost of ownership and the cost of maintenance, and they completely underestimate what it's going to cost them over the next 10 or 20 years to own that property. And I see it right up and down the country, and it's just becoming common thing. So back to the property factory. We break property down into what is the property type, house, townhouse, apartment, and what is our sourcing strategy with the deal. So these are just some of the types of deal strategies that we use. We look for a bulk discount based on volume. We've got one of those right now in Te Kawata, Waikato. And this one on the left is an example of Wellington. The next one is in North Lake Wanaka, which is Wanaka's largest and newest subdivision. And it's been so successful, it's 2.5 years ahead of its sales plan, which in the world of real estate is very rare. So we got involved with that. We're up to 40 odd houses in there now. And we were the first purchasers in that subdivision. And it's basically getting it at the lowest price possible for the land. An example there, we were paying $202,000 for our first sections and our first in stage 1 and 2. They valued up on completion at over $300 just for the land, forget the build. So that's a strategy we look for all the time, and I'm doing that every day. We also look at buying in early stage bulk build developments off the turnkey, off the plans. And in St Martin's Green in Christchurch, that's our biggest project in Christchurch. We did 67 in there, and our clients got a 27% return before they owned the property. We do the odd boutique stuff. We've done a lot of stuff in Queenstown where we've converted houses into short-term accommodation. We also got involved in another subdivision in Queenstown, similar to North Lake, similar design, but we got a little bit later. But it was still an early stage house and land project where we were doing turnkey houses for clients. And we also get involved in a project when it's finished and it's not sold. We go to the developer and say, you've got 10, 20, 30 units here that are unsold. We can help you sell them, but we need a discount. So my whole world is focused on getting the best deal possible for my customers, because I work on the basis that I want to employ all of my skills to give the client the best deal possible. And that is a very different mindset for the developers we deal with, because when I meet with a client, a developer client, a vendor, I basically put them through the grilling, whereas most real estate agents turn up begging for a listing, begging for the stock to sell. And I'm the opposite. I want to make sure that the client, the developer, is good enough for my clients, because developers are not created equal, locations are not created equal, and property is no different. So we are very, very fussy with what we list. We have put things through a lot of analysis, and this is some of our criteria. Location is number 1. Infrastructure plans in the area is number 2. Developers' DNA, their history, their performance, their balance sheet. I ask developers to tell me how much money they've got on the project. And some of them get affronted and say, that's none of your business. I go, well, yes, it is, because if you go under halfway through the project, my clients are tied up and they've wasted 1.5 years of their life waiting for you to build something. So no, I want to know that so that I can look my clients in the eye and say that you're real. I mean, I get on Google, I get in company's office, I ask around, I look under the hood of the developer's background. I then look at their design, and quite often, probably 20% of the time, I'll tweak a design of a project where they've designed it for owner-occupiers, but it's not owner-occupier stock. Those ones in Wellington that we were talking about before, that was a purpose-designed, purpose-built investment complex, and the vendor was left with 13 apartments. And these were dual keys, being a studio and 1 bedroom and 1 title. They were left with 13 of them, which was 26 tenancies. The annual rent from those 26 tenancies was $500,000 a year. And they gave it to a local real estate company who targeted owner-occupiers for 12 months, didn't sell 1 apartment, and lost $500,000 worth of lost revenue because they kept them all empty. We got involved, told them to rent them, and we had them sold in 3 months. We had them sold in 6 weeks. And those properties have doubled since then. So the product design is very related to the location. And the amount of developers I see who just get that wrong because they've gone to the architect and let the architect run amok is a lot more frequent than you realise. So we analyse floor plans, we tweak them, we draw on them, we send them back to the builder and say, you've got it wrong, do this please. And we work with them. Sometimes I'll go to a council meeting with the developer. Because at the end of the day, this is not a home. This is a rental property, and it's a home for a tenant who's paying you. So we look at who that target market is. Who is the end user? What's the rent going to be? Is the developer over-speccing it? Sometimes we tell the developer to cheapen the fit out because it'll bring the price back and make the return on cost better. We also look very carefully at market timing. I've looked at locations 3, 4, 5 years ago, which did not make sense, and now they do. Wanaka is a good example. 6 years ago, 7 years ago, I never, ever, ever thought we would be promoting Wanaka as an investment location. And it is still got a major shortage of rentals. So, you know, property changes, markets change, timing of the market changes, and we look at all of the above, and we're making investment decisions on behalf of our clients. So we've moved away from second-hand, and we're now buying off the plan, which is, again, for traditional investors or older school investors, this is a hard one. Because it's not, you know, they lost control, you know, they're not building, they're not hands-on. They're putting 10% down and crossing their fingers that the builder developer's going to deliver. Now, I look at it the other way. If we've got the right developer and we know what they're going to build, it's not a case of crossing my fingers. It's a case of jumping up and down that I've locked a price in today and I am getting that price held for a year, maybe 2 years, depending how big the project is. And the developer's taking all the risk on cost overruns, labour overruns, material overruns. And, you know, I've got 10% held in a lawyer's trust account, earning interest most of the time, while they have to take all those risks on and build something. That's gold. That's time saving. And we have not been involved in a project off the plan that hasn't gone up in the time that we, from the time we sold it to the time it was settled. Because we're really, really fussy and very careful what ones we take on. So I guess through us, we, excuse me, we have a lot of insider knowledge, and our clients get access to these, what we deem wholesale projects. And I'll show you some of the examples of those in a minute. So this is a really common strategy, and if you get your timing right in an off-the-plan project, you can make a lot of money between the time you purchased it on paper until the time you get the keys and you've got tenants paying you rent. And yeah, it's amazing how you can make money from boring stock standard deals just through market timing and buying at the right time and waiting for the developer to deliver a product that's going up as they build it. So the proof is in the pudding here. These aren't just made up numbers. These are, every representation I make is real. I can't, I'd be sued if I didn't deliver you what I'm telling you. So this was a deal where we bought 4 in a complex. We got the developer really early. He was desperate for sales. He dropped his margin. So we made $70,000 across 4 units here. So that's $280,000 on a purchase price of just over 1.2 million off memory, 1.1 something. So they valued up at 390. We got them for 320 each. And we then on-sold them. We didn't actually wait till settlement, because with a margin like that, happy to pay a real estate agent in the retail world a commission to sell them to a retail buyer at full value. And that's just a typical trading strategy. The Northlake ones, now I didn't expect this to happen. When I bought those sections for 200, so that buy is a land package, sorry, a piece of land, 200 grand, 202,000, and a build just under 300,000. Total cost 500. So that's what we were doing early on in Northlake. And when we got those houses, they valued up over 700 grand, 720 to be precise. Now, I didn't expect that. I never saw that coming. I thought maybe 600 on a good day, but not 700. And we rode that market timing in Wanaka beautifully. And I've got 30 odd very happy clients that came in off the back of that initial investment that we made. And I guess I see this, to me, this is like nothing special. I see this all the time. And we've got projects right now that have, in my opinion, similar gains ahead of them. But if you talk to locals in Wanaka about North Lake when it was just a paddock, they were going, oh no, it's not this, they're too small sections, no one's going to buy those little houses. But they didn't realise that the world's changing, and the people weren't buying them, people were queuing to buy them. On release day, they launched 60 sections, and they had 110 buyers for the 60 sections. And now they are 2.5 years ahead of their scheduled program. So same developer in Queenstown, we came in at the end of this project, so the margins were lower, but they were still very healthy. 126 grand in the course of a house and land build, that's a lot of money. So we got the last 13 sites at Bridesdale, Queenstown. Back to Wellington, this was a very old project, but these were dual key apartments in central Wellington, just off Tory Street. And our clients got good gains on those because we were buying, I think at that time we bought 30 in one tranche, and we got a really good wholesale discount off the builder. This is a bit of a one-off. This was again, we look at everything. I had 2 of these properties under contract. I unfortunately only confirmed on one of them. The market then went crazy, and we did a quick cosmetic reno and bought it for 505 and sold it for 785. And that was in just over 14 months. So I'm showing you these examples not to beat my chest, to show you what's real and possible in the world of real estate. And, these deals are in the market every day. You just got to know what you're looking for. So we've got a heap of examples on our website of our previous deals. And I guess that's our catch cry. We walk the talk. We don't make stuff up. We love what we do. And I look at every deal with very glass half empty eyes. And every time I tick a box on it, I get more and more half full. And that's how I look at it. I've got a very long checklist, and our track record speaks for itself. So before I just have a quick look if anyone's got any questions. I don't think they have at the moment. That's good. But if you have got questions, feel free to just type them into the question box. David's going to be talking at some point, still not at some point, but soon. And so I'll have a break and I'll be able to look at those questions. So if you have anything pressing, please type it into the box, and when I get to a pause, I'll be able to look at those and answer them. So let's just look at the market at the moment. I'll be updating this in Q3, which we're in now, Q4, which is in October, so it's next month. I typically do it every 3 months, and it's been the same old story. The only real changes that we're seeing is, that came out today and it didn't drop, is the OCR. But if you look at New Zealand as a market, immigration's strong. Our peak was 70,000 people per annum. We're cruising along at the moment about 30 to 40 on average per annum over the last 10 years, with peaks of 50, 60, 70. But our population is under pressure. Interest rates are low. They're expected to keep going down. We didn't get a drop today. We've got a no change. We're also hearing in the market that LVR restrictions are looking to being eased. And that means the banks are going to start freeing up the money again because the rules have changed in Australia, and Dave will talk about that later. We still have a massive shortage in housing, and that's not just homes, that's rentals. If you look at the rental market, or the pool of tenants renting, that number is increasing all the time. We are unfortunately dropping in our home ownership rates, and that's sad as a Kiwi. And I just turned 50, and I am determined to work as hard as I can to get young people onto the property ladder, because they've never ever, the crazy thing is banks are tight with investors, but my gosh, are they favourable to first-time buyers? And we've got historically low interest rates. We've got brand new housing at cheaper than new, than second-hand, sorry. We've got some locations where the price is, it's cheaper to own than it is to rent. So the tenants paying you rent could own it for less, but they don't know how to do it. So we've got these really strange things going on in the market. And, there is a lot of people getting into it, but not as many as could be. Government putting up prices on existing property, and we've got these regions, massive changes in their property cycles based on a lot of things I'll talk about in a minute. And this demand isn't just me ranting on to people to get out of second hand. It's happening in the market, especially with migrants. They much prefer to have new houses than old. they're not used to older houses where they come from. They're used to apartments that are warm and more than and typically warmer climates than New Zealand. And one of the things I'm predicting, excuse me, just having a drink. One of the things I'm predicting is that we're going to see a shift. In 1982, New Zealand had one of the highest home ownership rates in the OECD. It was 82%. I'll never forget it because it's 1982, it was 82%. So 82% of us owned our own homes. So if you look at the rental market back then, it was tiny. And it was probably, of the 12%, it was probably 70 or 80% made up of Housing New Zealand. So we had a tiny, tiny, tiny pool of investors in the country because we're not a very young, old country anyway. Our country's quite young. So since then, home ownership rates have been dropping. People haven't been getting on the property ladder. And we're starting to see institutional tenants. Now, what happens over time with that? Big corporates start thinking about property as an investment vehicle for their funds, for the institutional money that they borrow. So take Hong Kong, and the mid-levels in Hong Kong. I grew up in Hong Kong. Everybody that I went to school with, they lived in an apartment that was either rented or owned. And because most people that lived there in those days were there for a few years and they went back to their country, they were expatriates. Now in Hong Kong, the institutions are buying land, building apartments and renting them. They're not selling them. They're not selling them to owner-occupiers. They're not selling them to investors. And I think New Zealand's property market is dropping in ownership, home ownership, or owner-occupiers, so much to the point that the rental market is growing because every time someone's not buying a house, they're renting. So that's another customer in the rental pool. And to the point that the big companies are starting to look at building rental complexes and keeping them for yield, keeping them for dividend. And it makes sense when you've got a growing customer base of tenants. And it's sad with my home ownership and patriotic Kiwi hat on. So that's a quick update of the property market. I can just see one question. I'll have a quick look at it in case it's something really pressing. Do I think that land gives you more capital growth? It's a general question. The best place to buy, the cheapest place to buy any property is land and then build and add value. But we've got such a interesting property market in certain locations at the moment that I think it's actually cheaper to do turnkey where someone else is taking all that risk on. So typically, yes, buying land and building and adding value is the best way and the safest way and the lowest risk way. But in general, there's always an exception to the rule. And we've got some examples where right now it's a lot easier to let the developer do all the heavy lifting and just put 10% down. So I'm going to introduce you to a thing called the property clock. And if you haven't seen this before, it's a very, very simple and easy to use tool to basically predict where a suburb, a city, a region, a town is at. Because property is unbelievably cyclical. We as a country have moved in 7 to 10 year cycles. Our cycles are getting longer. And that's an interesting measure in itself. But if we look at New Zealand's property cycles being 7 to 10 years long, I've lived in 4 of them. And I bought my first house off the back of the 1987 stock market crash, and that was in Wellington. Interest rates were 12%, 10+% yields was normal. In fact, we bought on a 12% yield, but the money was 12%, so it was all relative. So property is very cyclical, and even though prices go up and volume goes up and demand goes up, property tends to follow a very similar pattern. And that's all to do with economics. And there's the 3 subjects you should do if you're a property person: accounting, economics, and law, because property touches on all of them. So this is the economical summary of property. When there's oversupply, prices go down, volumes slow, and construction dwindles. And then all of a sudden you get to the bottom of the market, and that's what we call 6 o'clock. So prices at the top of the market are 12, prices at the bottom are 6, and in between we get this oversupply, we get falling sale, falling volume, construction slows, blah, 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 and we hit the bottom of the market. And if we had the benefit of a crystal ball, we would buy everything at 6 and sell everything at 12. But the Dominion Post or the Herald or the ODT or the press don't exactly give us, a couple of months warning to sell all your properties because the market's about to tank. No one has that crystal ball. So we have to read the market. So you apply this clock theory to a suburb, you can apply it to the town. And, if you look at parts of Christchurch where I am right now, some parts are mildly oversupplied, some parts are grossly undersupplied. Some parts are at the, in my opinion, bottom of the market, and I'm talking CBD Christchurch for a whole bunch of reasons, which I'll talk about later. Using this clock analogy, it's very easy to predict where a market's at. Some parts of Auckland, in my opinion, are at 12 o'clock. Other parts are probably about 9, the infill housing, the higher density, brand new townhouses that are going up for 600 grand in suburbs that have an average price of 800-900. That's 8-9 o'clock. There's a lot of growth in those properties. They're brand new, double glazed, 10-year build guarantees. And they're sitting next to single glazed, horrible, miserable, cold properties, which in my opinion are absolutely at their peak price-wise. So you've got markets within markets. And you've got places like Wellington, which has had a massive growth period for the last couple of years, or last few years. So that's not at 6 o'clock at all. It's at 9 and rising. But if you look at some parts of Wellington, Upper Hutt, Kapiti Coast, you've got a lot of legs in them when the likes of Transmission Gully comes in, and the people moving to the Wairarapa will force the government to upgrade those roads. So markets within markets based on volume, supply, demand, construction prices. There was a time you could count the number of cranes in the city and get a gauge on the construction. So, we want people to buy at 6, 7 o'clock and sell or reinvest at 11 and 12. And that's the cycle. You don't have to sell. Not everyone, safe investing is not trading. And rather than sell at 12, reinvest that equity, because whilst you own it, if it's paying for itself or it's paying itself off, well, it doesn't matter what the market's doing, you're going to hold on to it. But recycling the equity, getting your money out of that property can be done without selling it and putting it into a new property. And it's really scary. The people that are on this webinar are serious because they've given up their Wednesday evening to listen to me rant on about the best places to buy and what to buy and how to buy. Most people in a market, no matter whether it's stocks, shares, property, whatever, are sheep. They follow. And it's counter-cyclical to me, but they do. And they do because they're not informed, or they get their information from the newspaper, which is not a research house, and it's scary. And let's just look at some of the locations that I'm talking about. So this is Auckland in the blue and New Zealand in the orange. And if you look at Auckland, it literally sets the New Zealand pattern. And if we look at, get my mouse on the screen here, I think you can see it, I think you can. If you look at 2008, that was literally when things started to button off and go down a bit after the global financial crisis. July 2007 was the epicenter of the global financial crisis. It's when money was not available. Banks were having a run on deposits. There was no money. You couldn't borrow money no matter who you were. It was called a liquidity crisis. So the median sale price went backwards. But if you look at it over the last 19, 20 years, it's actually a blip. And if you look at Auckland from 2012 to 2018, it's like Mount Everest, steep. Prices doubled in that period. And, those people, all those people living in Auckland that own multiple properties became multimillionaires. But it's all on paper. And unless they reinvested that money somewhere else, not much really changed apart from their wealth on paper, but their rent didn't go up much. And unless they got their money out of Auckland and put it into other markets, it doesn't really matter where if they bought these properties 20, 30 years ago, they've gone up in value, but they haven't really changed their life from an income perspective. So that's Auckland. Let's have a look at Hamilton. Similar, so nowhere near the same as steep as Auckland, but following the New Zealand trend. and it's had a large couple of years growth since 16. Hamilton's the bright orange, not the light. That's New Zealand, and now it's sitting at the New Zealand national average. That's a safe place. That's 8, 9 o'clock, and if you look at the infill housing going on in Hamilton, they're at 7 o'clock, 8 o'clock at best. So there's still a lot of growth to go in that place because you can buy property there for $500,000. It's brand new. Te Kawara, we put this on the graph here because Te Kawara is a town halfway between Hamilton and Auckland. It's been identified as a seriously real growth centre. The high-speed train that will eventually go between Hamilton and Britomart will stop here, and one of the country's largest developers is building 1,300 houses in Te Kawara. We have a relationship with them, and we were cynical when we first thought about Te Kawara, but like Wanaka, it is poised for growth. And it's a commutable road between South Auckland and Te Kawara. It's a commutable road between Hamilton and Te Kawara. So this is our, I wouldn't say oddity, but if you'd said to me 3 years ago, would you invest in Te Kawara? I said, no way. But when I see a developer putting 1,300 house and land packages in there, they're turnkeys, a whole community with a business centre, a sports area, a proposed new school, that stuff brings people, and people rent property, and in the subdivision, it'll be 10, 20% rentals. So I can't see there being anything but high demand for those properties once Te Kawara has been quadrupled in size. Let's look at Wellington. Wellington was the purple line and the green line is New Zealand. It's just tipped over in the last couple of years the New Zealand average. But comparing it to Auckland, which average house price is nearly $1 million, this is still in the sixes. So Wellington's still got a lot of growth. It's a safe city. It's a safe city to invest in. It's getting harder and harder to find yielding property in Wellington. And if you didn't get into Wellington in 14, 15, you're coming in at the end of the current cycle. But one thing you'll get in Wellington is consistency of income, and it's a safe place to invest from a rental point of view. So that's a quick synopsis of Wellington. Christchurch. Now this here, in my world, is a graph that has an alarm bell going all over it. So it's going ding, 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 time to buy, time to buy, time to buy. The orange line is New Zealand's national average for the last 20 years, and the light grey line or blue line is Christchurch, sitting at $450,000. This is our second largest city, the second only 24-hour airport in New Zealand. Direct flights to China, one stop to Europe. I mean, this is crazy. I cannot believe Christchurch's national average is that much lower than all of the other centres that we were looking at. So to me, at some point soon, and it's because of the earthquakes, and I won't go into it for too long, but the reality is 80% of the CBD was destroyed. People went out into the suburbs. Builders oversupplied the suburbs with land, with house and land packages. So Christchurch in the last 8 years has no questionably received oversupply. And that has been in the burbs. But if you look at the CBD, every complex that we've seen, every complex we've been involved in, and we've been involved in Christchurch since 2013, after that tragic earthquake in 2012. So we've been in this market for 5 years, 6 years now, sorry. I've never seen so much construction and infrastructure spend, and against a lot of what the press say, it takes a long time to rebuild a city. 80% of the CBD was destroyed in those earthquakes. 80% either came down or had to be pulled down. And their forecast population for the CBD is 20,000 people. That's bigger than the CBD of Wellington. 20,000 people are mentioning the CBD of Christchurch. You can't tell me that prices aren't going to go up here. The land that our clients, our developers are buying now is twice what it cost 3 years ago, twice. So we're still seeing last year's prices, and it's not going to last. And for us, it's the hottest market in the country right now. And we have to pinch ourselves when we do the cash flows on Christchurch properties, because there's pretty much nothing here that's not cash flow positive. Queenstown, still a place you can invest if you do the right thing and look and invest in the right location. Green's New Zealand, pink's Queenstown. The trouble with Queenstown is if you buy in the wrong location, you can get caught at 12 o'clock. And if you can fund that through a slowdown, great. But, it's not doubling in those. There's certain places in Queenstown that will not be doubling in the next 3-5 years. It's got long-term growth with it. They're talking about tourists, current number of tourists per annum in Queenstown through the airport alone is about 2.5 million, forecast to go to 5, then 7. So that's crazy. Now, but it's not crazy because it's Queenstown, and Queenstown is our absolute shop front for the world. People think of Queenstown when they think of New Zealand. It is our tourist mecca, and it is turning into the Vegas of New Zealand. It is a holiday, fun, high energy, high adrenaline location, and it's not going anywhere anytime soon. But when you're buying rentals there, when the average price is over $1 million, you need to know what you're doing. So we're in this market, but we're not at $1 million. We're at much lower levels, and we are working with a couple of developers at the moment on projects that will have 4, 5s, and 6 in front of them, and that's where it's still safe. Wanaka, same again. We're doing properties in the 7s with the average house price of over $1 million, and in the 7s they're renting 600 odd weeks, so the yields are low, but you're in a capital growth location and you're buying at the bottom end of it, i.e. you're buying at the 30% below the median, and that's safe. Central Otago, again, Cromwell is not a place to be ignored. The Golden Triangle in the North Island, they call it the Golden Triangle, is Auckland at the top, Tauranga to the east, and Hamilton to the west. Hamilton is the service centre for the other 2 places. It's the inland port. It's the service location. Same with Cromwell. Wanaka up to the northwest, Queenstown to the west, and Cromwell's the service town for those 2 places. Now, the big talk in Wanaka and Queenstown at the moment is what's happened to the airport. Queenstown Airport forecast to go to 7 million people. They can't cope with it. So they're talking about taking the international flights to Wanaka. They're talking about taking the domestic flights to Wanaka. No one really knows. The only thing they do know is that the Queenstown Airport Company, which is co-owned by the Queenstown Council and the Auckland Airport Company, has bought every piece of land available around the Wanaka Airport, and that the council, the Queenstown Lakes District Council, have handed the Queenstown Airport Company the rights to take land back. And not many people are aware of that, but the one thing is for sure that there's a lot of growth to go in Cromwell, Wanaka and Queenstown based on population growth, based on infrastructure spend, and based on the fact that a lot of people are finding that location as a destination to live, and the people that are buying rentals down there is a destination to rent. So do not ignore Central Otago, but be very, very careful on where you invest. So to summarise that, let's look at the country. Blue line is Auckland, black line is New Zealand. Sorry about the resolution, it's a bit hazy. The green line is Tauranga, the orange line is Wellington, the purple line is Hamilton. Now the bottom line, the blue line, is Dunedin. That's just crazy. Dunedin is about to surpass Christchurch as average house price. Now, I wouldn't invest in Dunedin. I have in the past, and I wouldn't invest there as a rental location because your main market are students, and they aren't there for 52 weeks of the year. They're hard on property, and they're a flight risk because they're very volatile which university they'll chop and change to. And I've been in that market and I've been caught, and I wouldn't invest there at the moment because there are other places which make more sense. There are other places which are much safer, and if you want to go and live there, great. It's a cheap place to buy property. It's a beautiful location. You're only 2.5 hours from Queenstown. But from a rental perspective, I'm putting it on that graph to show how crazy Christchurch is, which is the red line, in that it's the only one flatlining. And it's had no steep pitch for a long time, and I don't think that's going to last. That's my quick summation of the country. So to sum that up, capital growth, Christchurch, Central Otago, regional centres within 1.5 hours of the capital cities, Auckland in very specific locations. Christchurch land prices are just historically low, and the light at the end of the tunnel on the rebuild is there. The Justice Precinct, 1,200 jobs, is finished and full of people. The new sports complex is underway. The stadium is the last one to go, but it will be an amazing addition to the city when it does get built. And they've pulled the trigger on it, but they haven't started construction yet. The convention centre is 70 or 80% finished. It's going to be amazing when it's finished. We've got a whole lot of things going on in the South Island, and also locations in the north. But we're really picking Christchurch as the hotspot at the moment because of it's where it's at in the construction process. So let's jump back to simple rules with property. Property is not rocket science, and it's a business. And the reason most people don't succeed in it or don't last in it is that they just get it wrong and they buy the wrong properties. Now, there's a key thing in real estate called cash flow and capital growth. Cash flow is your oil, capital growth is your engine or your power. It's where you make your money, but you can't make capital growth money without cash flow. Cash flow is what pays the bills, pays the interest, pays the rates, pays the insurance. A lot of people jump into property and they go and buy the flashiest house they can find and put a tenant in it, and they beat their chest and tell their friends that they're a rock star investor. And they don't buy any more. One property, that's it. And it doesn't work because property is all about funding through the ups and the downs. It's all about paying it off with the tenant. And I'm going to introduce a concept in a minute around that. But if you buy the right properties in the right order, hold them for 10 to 15 years, that's 2 cycles, focus all of the rent excess into paying off debt, you can literally live off rent in retirement. It's not that hard. It's that simple. Property 101 in less than a minute. And people who get emotional are the ones that stuff it up. And people who are self-employed or in a business are the ones that get it and get it right because they understand that it is a business. So 5 houses in 5 years is the typical rule of thumb. And how do you get there? You do it through balancing cash flow properties with capital growth. Now, your cash flow properties in the old days were the properties that I said that we were renovating in the 90s. It's your secondhand stuff in regional towns. But now we're in an environment where you can actually get cash flow positive properties that are brand new. And the rule of thumb is you typically buy 3 cash flow properties for 1 capital growth. And those cash flow properties will top up the capital growth, but net over the 4 of them will be cash flow positive. So if you end up with 5 properties, you might have 3 or 4 cash flows and 1 or 2 capital growth, but not the other way around. And it's amazing how many people get that wrong. And when you do that, it becomes self-funding. So this is all about recreating your income in retirement. You want to be able to say, I'm out of here to your boss one day. The only way you're going to do it with property is if you build up an income stream that replaces your personal income. And a lot of people, they read the articles of the LVR rules have changed and we've got a bright line test of 5 years and they're ring fencing losses. And they don't actually know what this stuff means and they don't buy it because of it. And bright line test is basically is just taxing people that are making money out of buying and selling property that weren't declaring themselves as traders. And if you own a supermarket, you buy and sell beer and cigarettes for a profit, you have to pay tax on it. Well, property's no different. So the government decided that people who are buying a house and living in it for a year or so and then selling it for a gain and not paying tax on it, they're going to catch them. So that's called capital gains. That's making a profit for buying a house to make a profit, not declaring it. So I don't have a problem with that. Same with ring fencing of losses. We lost appreciation as an expense a number of years ago because people weren't reinvesting into property. It's crazy. They should have been spending the tax benefits they get from being an investor on the maintenance and the upkeep of that property. And people haven't been. Kiwis have been very loath to spend money on their rentals. And now we've got a substandard housing stock across the country. So what the governments have said now, I said, right, well, you can't have those losses because you used to be able to get the tax losses and get a tax refund from the government if you were paying tax as a PAYE, salaried employed, or a salary earner. They've said no to that now. So if your company or trust owns a rental and it's paying, and it's got some tax credits in there, which it will, you can't take those against your personal name. But that's not a bad thing because what you can do is use them against future profits. So when you're 60, 70 or 80 and you're living off rent, you actually won't be paying tax. So it's a forced savings plan and it's brilliant. Okay, I'm going to have a break now and I'm going to look at some of these questions. I'm going to hand you over to the infamous David Howes, who's the brains behind our operation. So I'm going to mute myself so that David can unmute himself, and I'll look at the questions in the meantime. So here is David.
All right, thanks, Campbell, and hopefully you've handed me over the mouse so I can control the screen. You have. Brilliant. Hi, everybody, and thanks for coming on tonight. Brief introduction, I best bought my first property. It was my own home to live in, age 19 in 1990. I've been in property for a long time. I've known Campbell for 17 years now and been in business and invested with him for all of that time, and I've had a long history investing, trading, renovating, some developing just on a small level. And if you've heard of Real Estate Investor, Campbell and I co-founded that technology company in 2006, and we built that business up over the space of 10 years. So overnight success, just 10 years in the making, and we listed that on the Australian Stock Exchange at the end of 2015. So we've been involved in real estate, but also real estate technology as well. I recommend that you keep your investing simple and boring and repetitive. And if you do that, you'll get a predictable, reoccurring result. And one of the things I do, which I encourage you to do, is have hobbies or interests or passions that generate a bit of excitement for you that aren't related to real estate. Because if real estate starts getting exciting, sorry, the screen's just jumping around a bit here. Real estate starts getting exciting, then sometimes you're trying too hard. So I do a bit of sailing. I get offshore. I've done Sydney Hobart. I've sailed solo from New Zealand to Australia in the solo Trans-Tasman race, which runs each 4 years. And it's easy. I'm 49. It's easy to spend too much of your life in real estate and in business and making money, and forget you can't take it with you. So I encourage you, as you build your wealth, to find some passions or hobbies that get you outdoors and keep you fit and keep you mentally challenged as well. So at the Property Factory, I mean, our model is simple. What we're trying to achieve is we're trying to match buyers and real estate. And although it's simple, it's easier said than done. And so our core focus is apartments, townhouses, and house and land opportunities in key locations around the country. But then we're focused on property investors primarily, but also getting people into their first homes, as first home buyers. And, from October the 1st, there's going to be finance available to 95% of the purchase price, as opposed to 90% for first home buyers, at rates of around 3.55% interest. So it's never been a better time for first home buyers to enter the market. And we encourage first home buyers to think about becoming first home investors by maybe buying a property with an extra bedroom, so maybe 2 or 3 bedrooms, and then looking to bring in flatmates or tenants and rent a room out to help subsidise that mortgage and pay off the mortgage a whole lot sooner. And in many cases, it's smarter to get into your first home with it being an investment in mind, and then look to step from that into your real first home 3 years later and keep that as your first investment. So on our website, with all the projects we profile, we split out everything into long-term 20-year growth patterns, and then split it out into, if you buy it as an investor, what's the cash flow? If you buy it as a first home buyer, what's it going to cost you to own on a 10% deposit? If you buy it as a first home investor, what's it going to cost you to own? Okay, I will just Campbell, can you? Oh, there we go. Just a bit of a lag there with the internet. I'm in a different office location to Campbell. So on our website, well, jumping around. On our website is a bunch of resources that you can access. If you sign up for membership, wholesale membership is free at the Property Factory. So we're not here tonight to encourage you to sign up and pay for something or to sell you anything. There's a bunch of resources on our site that you can take advantage of. We're in the business of helping people get into property successfully, giving them a simple formula to follow and helping them to find and locate great stock. We're a licensed agency. We're a real estate focused agency, and our service is something you can take advantage of. So our goal is to provide online resources to you to help to make it easier for you to access this information 24/7 from wherever you are. We produce a lot of content, videos, reports, articles, podcasts, so take advantage of all of that. We've got a pretty straightforward investment process that we can help you step through, particularly if you're an early stage investor. But essentially, we are great at what we do from a property sourcing and critiquing and research point of view, but we partner with companies all over New Zealand that are experts at what they do, so that collectively as a team, from finance to accounting to financial planning to data and information, we can help you to move your strategy along. So step one, if you've got existing investment property or you're not quite sure where to go next, or you're new to investing, if you sign up for wholesale membership, one of the things you can do is request a free property acquisition strategy report, which will basically allow us, we ask you for 6 pieces of information, and we can take that and produce a 6-page report, which helps you to then see a pathway over the next sort of 5 to 10 years as to how that might look based on your rate of acquisition, or based on how fast you add property to your portfolio, whether you've got none right now or whether you've got 10 already. So that's a great service that you should take advantage of, and it'll help to put a stake in the ground in terms of where you are and where you can go next. We also have a number of clients that we work with that have complex financial affairs, businesses, other investments, multiple bank accounts, multiple credit cards, all sorts of stuff going on. And we're not licensed financial planners, nor would we ask to see that kind of information. But if you do want somebody to put together a plan for you to help you understand where to go next real estate wise, and know that you can afford it, we work with a handful of planners across the country that can sit down with you, that can undertake a fact-finding process, look at all of your deep financial information, and then put together a strategy and profile that matches what you're trying to achieve. You'll pay anywhere from $3,000 to $5,000 across the country for that kind of report and that kind of service through the Property Factory as part of leveraging your membership. If you're a wholesale member, that's a $495 service, and you'll receive a personalised 9-page report, a statement of advice, which can only be provided in New Zealand by an authorised financial advisor. If you're one of our platinum members, that cost is included in your membership, so there's no cost there with that. So when it comes to step 3, property selection, often that's overlooked and people get a little bit too bogged down on it. I mean, at a simple level, you've really got to look at what's happening across the country in terms of timing, and have the view that you're going to invest in multiple markets. Absolutely, Auckland's a powerhouse, Wellington's a powerhouse, Queenstown's a powerhouse, but even those markets have periods where they go sideways or even backwards slightly for 2 or 3 years at the end of a long growth cycle. If you time your investing so you're entering markets that are at 6 or 7 o'clock, not 12 o'clock, then you're always going to have 1 or 2 or 3 or 5 out of 6 of your properties that are in an upward growth phase, and not all of them in one market going sideways at the same time. With real estate, cash flow pays the bills, but it's the capital growth that really creates that true wealth. So it's about making sure that you match the property to your situation. And if you haven't logged into our website, here's, I guess, just a really quick tour of the kind of research and analysis we do. So across all of the projects, we pull together the high level information for you. If you drill into a project, then we have a summary of the project and the price point. We pull together all of the metrics on the project, the property, what the numbers look like for home buyers and investors, but also we pull together all of the analysis, including the last 20 years capital growth data, so you can see the long-term picture, not just the last 12 months or 3 years or 5 years. And we do that for every project, regardless, and in some cases, they just don't make it to our website because the numbers don't stack up. We put in some of the key drivers to help you appreciate what median price is doing right now, and again, these are all 20-year trend graphs. Volume and value charts, so you can see how much stock's moving right now if you had to resell into that market, and also time on the market. It's a good gauge of supply. The faster a location is selling, then the more demand there is, and the less oversupply there is. We link to the mapping and street view tools and street and suburb demographic profiles as well. Bring in images, bring in plans, and then as much as we can get from the developer, as well as information we commission independently, i.e. valuations and independent rental appraisals, all that's available for you to download and consume, and then all the high level of numbers are provided as well. And so we take that ourselves to make it easy for you, and we pre-calculate all of the cash flow and growth for both investors and home buyers. And on the left-hand side, that you'll see the assumptions we've used in the forecasts, so that you know when you're looking at that picture what's been included, what's been excluded, and what those numbers are. So it is paint by numbers, and as Campbell said, the goal is to take all the emotion out of it and focus on location first, quality next, look at the numbers, look at the developer, and look at how that strategically fits into your portfolio. at the bottom of every page, there's the first home buyers calculator and a property investment analyzer. You can use that yourself to crunch your own numbers. So it's completely up to you as to how you take advantage of that. I guess last but not least, it's easy to get a property under contract and then have all sorts of setbacks when it comes to getting finance. So one of the things that we do is we work with a number of specialist investment brokers across the country, and to make sure that when we have clients that are looking to build portfolios, they don't run themselves down a dead-end street by putting everything with one bank and then finding out they've got issues later with security and not being able to refinance, and banks limiting their progress. Most people understand LVR in terms of the percentage of a property's value or purchase price you can borrow to. A lot of people don't understand the DSR. And so debt servicing, or the ratio of income to rent, is another key indicator to the bank, and when it comes to them looking at equity and servicing. And what most investors don't appreciate is if you manage the ratio of rental income to mortgage payments at a ratio of 1.3, or in other words, $130 of rent coming in for every $100 of mortgage payments going out, then the bank will look at that property as standing on its own 2 feet from a servicing point of view, and they're not looking at your income to top up the shortfall. If your debt service ratio is lower than that, and sometimes we have investors, having $1 coming in rent with $1 going out in mortgage payments, and the bank knows you've got to cover rates and insurance and repairs and vacancies, then they're going to knock you back and start to eat into your personal income and look at the surpluses from that. And then you may, as often happens, be limited by your income and your debt servicing, even though you've got truckloads of equity, particularly if you're in a market that's grown rapidly in recent years. So use a good broker. Don't put all of your eggs in one basket or with one bank. Get a specialist, and just understand the world has changed a lot in the last 2 years. And in Australia, there's been the Royal Banking Inquiry into banking and mortgage broking. Those banks in Australia own 4 out of 5 major banks in New Zealand, and that's affecting New Zealand as well. And just to take a step back and give you a high level understanding of that, go back 5 years, apply for a mortgage. What are your living costs? You fill in a form. Here's what they are, so on and so forth. Great, got the mortgage. That's all changed now. The reserve banks in both countries are now saying, as a broker or banker, you must analyze their actual credit card and income and expense statements, or bank statements, and identify what they're actually spending. They're also using big data to risk profile you. So guess what? If you withdraw money out of the same ATM every Saturday night, just down the road from the casino, you may have never missed a mortgage payment, but they're now saying to analyze your habits and say you're a potential future risk because of your online or ATM or electronic shopping habits. So be aware that banking's changing, and how Big Brother's getting to know the client is changing as well. The good news is, if you're a clean skin, as we call them, in the wine industry, then you'll be able to borrow money forever. If you've got all sorts of habits that could lead to your demise, then you might find the bank saying no, even when you've never missed a payment. So just be aware of where the market's going. So, a couple of things. To have an unlimited supply of finance, then outside of good character and a good credit reference and good credit check and history, you need equity and income. So on the equity side, here's some tips. Buy at a discount. Buy at an early stage in the project, buy in locations that are 6 to 8 o'clock. So all of those things create either instant equity or equity shortly after purchasing, or equity between purchasing and settlement, particularly when you're buying off the plan. Sell out of low growth areas. There were, 20 years ago when I started investing in property as an investor, everybody went to regional New Zealand for cash flow. That was because interest rates were at 7 to 9%. And if you were buying in the main centers, they were good growth locations, but the cash flows were pretty negative in terms of low yields and negative cash flows. Today, you can buy in prime locations across the country, brand new property, positive cash flow, no repairs and maintenance for 10 years. It's never been a better time. So if you're sitting in properties in the Wanganuis and the Dunedins and the Gores and the new Plymouths and, the Hawke's Bays, I've not been overly critical or trying to single some of those out, but unless you've got a unique property, think about looking at its historical performance and selling that property and putting your money into better growth areas with lower maintenance costs. A lot of people focus on gross yield, and it's often a fallacy. I know in my early days when I started buying investment properties at $120,000 purchase price, this is in the Auckland market, rents were $200 a week or about $10,000 a year. Sounds good as a gross yield, 10%, right? But if you have $2,000 or $3,000 worth of repairs in that year because it's an old property, 10% becomes 7% real fast. The same applies today. So think about those things. From a servicing point of view, buy property at DSRs of at least 1.3. On our website, we produce the DSRs for every single project, every single property, now and into the future. So you can see that information up front and you know, join the dots from a numbers point of view. Buy dual key or dual income. We've got lots of those types of projects. Review your rents regularly, or make sure your property manager does. Renting out rooms on a short stay or long-term lease can add extra rents. Airbnb is a great example. And then, you know, short-term rentals, mixed-use type opportunities. And we've got a project right now, Latimer Central in Christchurch, where it's separate access to the the 2-bedroom units, dual key access. On one side's a room and ensuite. On the other side's the other bedroom plus ensuite plus kitchen plus lounge. And we've got clients that are purchasing to live in one side and then rent out the other side on an Airbnb type short-term mixed-use type basis. And, you know, if you've had a great one with property, but you've got properties that are returning, you know, 30 or 40 grand a year in rental income, and they're worth $700,000 or $800,000. They may be great returns on what you paid, but they may be low yields on what they're worth today. So look at trading those and getting into high yielding property. And, you know, I often say to people, when you're looking at property, don't look at the pretty pictures, look at the numbers when you're making a decision. So, you know, again, wholesale membership is a great resource. We've got lots of members that are signed up and accessing all those resources. So take advantage. It's no cost at all to do that. And back to you, Campbell.
Thanks, David. I was just, you were going a bit funny there on the speech thing. I didn't get a chance to answer those questions, so I've seen a few questions in there, but I'll get David to answer those. So I'm going to speed up a little bit because we're a little bit behind. So that's a good summarization of our business by David. So one of the questions was actually, I'm about to answer it, so hopefully this satisfies one of those customers. So yeah, we aren't a typical real estate agency. In fact, we act more as buyer's agents, but we are paid by the vendors because we go to vendors who need sales. They don't want them, they need them. We know they need them because they haven't got bank funding without sales. And as an ex-developer, there's two times where you're desperate for sales as a builder developer. It's right at the start and right at the end. So we typically pick up our best listings or our best stock at those times. And but in the meantime, there are other, you know, there's also properties that just make sense regardless of start or end. David, if you could just mute yourself, that'd be great. So I'm going to rip through some of our deals. Not all of them, just some of them. Each deal has its own driver. Not one is better than the other. Everybody's financial circumstances are different. And it can be the difference between a 5.2% yield and a 5.6% yield, or a 4.8% yield and a 5.3% yield, that makes it more sensible for you than not. Property is all about the numbers. So we, as David said, break it down to the last cent, and the banks use very similar metrics to approve or decline your loans. So when we actually help you match property, we use a financial advisory model that has been given to us by one of our partners to recommend what properties you should buy. So it gets that formulaic. And I guess that's where we're not a typical agency. We are not selling you whatever we've got. We are matching you with the right property. And if we haven't got it, we'll let you know that. So these are some of our deals. They each have their own economical driver. They're not right for every person. And one of us, or one of our staff, or one of our partners will help you understand that. So this is in Te Atu. Somebody asked me, are we doing properties in South Auckland? Well, yes, we are. And here is one of them. And this is in Te Atu South. And this is actually in West Auckland, not South Auckland. And these are 2-bedroom properties in the 6s, settling next year. It's cash flow neutral. And if you look at the suburb, it's had good growth, but it's nowhere near the top of Auckland's spectrum, which is why this is still a 9, 10 o'clock suburb with infill housing. So this is infill housing in the world of Auckland, where 4 houses have been demolished and they're building a number of townhouses in the spot. However, the other thing we also do is we try and get something for our clients over and above the norm or over above the market. So in this project, we're getting clients $10,000 in cash at the end, or once it's finished, as a cashback to help with year one expenses. So if you've got 2 or 3 weeks vacancy, that's cool. You're going to have a $10,000 buffer for your, let's call it your rental account or your trading account. And this is a typical type of investment incentive that we get, just to make it a little bit softer when you first get into it. But if you look at this location, 15 minutes from Auckland CBD, brand new property, 10-year build guarantee, amongst properties that are typically single glazed and run down, this is pretty hard to beat. This is going to pay itself off over time, capital growth and rent increases. Lakeside Te Kauwhata. So these are these properties I was telling you about before. These are 3-bedroom, architecturally designed house and land packages with 1 or 2 bathrooms. They're from 537 grand. We've only got 10 available. Then what we've done here, we've actually got a bulk purchase. We've gone to the developer and we've said, right, give us a special price for 10 properties. So if you go onto the developer's website or through the agency that's selling these locally, you will pay more than this. We have negotiated a discount between $10,000 and $12,500 per sale, and that's in purchase price. And this is a turnkey product, so you're paying 10% now, and the balance in completion, which is in the middle of next year till the end of next year. Now, this is the crazy thing. This is a brand new subdivision. It's going to have stunning streetscaping. If you look at the website, on our website, you'll see some videos and photos and renders. They're building a lake. They're building a whole new suburb of infrastructure with sports facilities, shops, and it's like Rolleston in the South Island, or it's like Hamilton, where Hamilton grew many years ago significantly. So this is the next big town to happen in south of Auckland. So what I can't get over though is these houses are architecturally designed and they're beautiful and they're cash flow positive. And that's because of today's interest rates. The forecast rents are real, $600 a week for for a tenant. And how we package these up, we package them up for the first home buyer, we package them up for the investor, and we also what we call first home investor. And the first home investor, somebody who's going to buy the house and live in it and rent out 1 or 2 of the bedrooms. And it can be as cheap as $300 a week for someone to live in this house if they're getting flatmates. Same with the investor. It's pre-tax positive at $600 a week, $78 a week to $113. So that's so rare to find that in a brand new house and land package. And the money that's being spent on this location with roads and trains upgrades is just crazy. It's a huge infrastructure upgrade. So that's Te Kauwhata. Now we're down in Hamilton. We don't have many of these left. I think there's only 1 of these left, and these were basically 2 bedrooms for under $500,000, cash flow positive pre-tax. Again, we're getting a $10,000 furniture pack included in that price. So these are the things that we go and get off the developers so that the deal is better than retail, better than something you can find on Trade Me. And this is a brand new set of architecturally designed townhouses in Cromwell, which is the pointy end of the Golden Triangle in central Otago. These are 3 bedrooms, architecturally designed, but where their key is, we help design these, and they're room by room. Sorry, they've got bathrooms off every bedroom, which means that they're suitable for a room by room tenant market. Very common in the cities, and with such a rental shortage in Wanaka, Queenstown, and Cromwell, we believe that an executive will rent this as a home, or workers will rent them room by room with a couple, or just as a single. So we're talking just under $1,000 a week for these. There's only 7 available, and this is 45 minutes from Queenstown. And low 6s to early 7s in a location which is supporting Wanaka and Queenstown. So that to me is just a no-brainer. And last but not least, I've got a couple now in Christchurch. So these townhouses are in Riccarton Park. Riccarton Park is 8 minutes to the airport, 15 minutes to the CBD, and about 6 minutes to Canterbury University. It's a very old suburb, and the average house price in this location is more than these townhouses. So to find something like this for $500,000 or just over $500,000, it's brand new, 3 bedrooms, 2 to 3 bedrooms, in a really I guess, seasoned suburb, let's call it. I mean, Rickham Park is a very, very, it's got shops, it's got schools, it's got infrastructure routes. It's really, it's an old suburb. So to find brand new housing, and this isn't a subdivision built by Ngā Tahu, they're one of the best land developers in the South Island. So these architecturally designed townhouses I'm picking are going to go up significantly on completion, and we're getting $17,000 to $30,000 discounts off the plan. So I believe people are going to make a great equity uplift with these in a flat market, and when Christchurch starts moving, you'll get capital growth as well. I think they're extremely cheap for what they are. So let's jump now to the CBD of Christchurch. This is Laneways. It's on Churn Street. If you Google Churn Street, it's right in the epicenter of the CBD. Not only is it on Churn Street, it's across the road from the Justice Precinct, which houses 1,200 people. There's 1,200 people working in one building. Now we're picking these will be perfect for the furnished or unfurnished market. And again, they're cash flow positive off pre-tax. So we just don't see this very often. Now we've got 7 of these with significant discounts. And when I say significant, I'm talking $40,000. So we've got 7.5% discounts off some of these, only 7 for our members only. So you have to be one of our platinum members to get this deal. And we've already allocated nearly all of them. And we will be getting another discount, but it won't be a 7.5%. So this is one of those examples where the early birds get the worm, and they're only doing it because they want sales traction. Harcourts are selling the same properties for $40,000 more off trademenrealestate.co.nz. So this is what I call a true wholesale discount. And I spent a long time convincing the developer that they needed to do this to get some traction going to our clients. And, that's one of the rewards you get for working with us. So location is unbeatable in this complex. So still again in Christchurch, which this complex is, the best way to describe it is that it's almost too good for tenants. It's architecturally designed, its fit out is stunning. And I don't want to sound arrogant saying it's too good for tenants, but if I was a first home buyer, I would buy one of these apartments. They're really big. Their meter rate is low. The quality of the build is as good as it gets. Because for a 5-story complex, the builder is using steel and concrete, which is the most expensive materials to use in something like this. It's also on Barbados Street, which is a north to south running street, and it's about half a block from the new stadium that's going to be built in Christchurch. It's about a 6-minute walk to the square. And again, like Churn Street, this location is just unbeatable. And this one is nearly finished, and they start in the low 3s and they go up to the high 4s. 1- and 2-bedroom apartments, but they're really big apartments. This will suit furnished and unfurnished tenants, accommodation. So you can, and this will be the type of place an executive coming in from Wellington or Auckland will rent. And it's going to have 50%, I'd say 30 to 40, maybe 50% owner occupied. And again, with today's interest rates, I just can't see how these aren't going to go up in price, because if this was in any other city in New Zealand, it'd be almost double what these are being sold for. So Christchurch is just so super cheap. It's because the land values were reset after the earthquake. It's because construction prices are at their lowest, and builders are just doing things on really low margins to keep their people employed and keep the stock turning over. So we've got this bizarrely unique period in Christchurch where things are just so cheap. So that's me. I'm just going to put on a slide now. I'm going to bring David back to talk. He can take you through those membership offers again. I'll be online and I'll unmute myself in a second. I don't know, David, you got, I'll just shut that down accidentally, sorry. Hang on, there we go. There we go. So I am, I'll let David talk now, and I'll hand it back to him, and I'll have a look at the questions and I'll come back and answer them. David. No, he is not. Can you hear me, David? I don't think you can. Actually, I'll just leave it on the slide and I'll go to questions, because His microphone might be out.
Can you hear me now?
Here it is. Got you now.
Sorry, the unmute button disappeared, but I've just used the keyboard instead the good old-fashioned way. Okay, cool. Thanks, Campbell. So I'll let you take a breath. But we had a bunch of questions come through, so I'll just and we'll answer some of those directly. But I'll read them out as well for everybody's benefit. So Katsutaka has asked, which suburb is hot in South Auckland, Manurewa or Pukekohe? Pukekohe's turned into a real satellite city to Auckland, as has Pokeno, as you know, Te Kawata's heading that way as well. And certainly there's some nice parts to it. I mean, Manurewa is closer to Auckland City, but depending on the quality of the location, there's some projects coming online out that way, particularly in the new part of Papakura where there's farmland being rezoned and converted into really nice 3-bedroom house and land type opportunities. And our West Auckland as well, there's some great projects. Te Atatu South, I reckon, is it's a bit of an unsung hero, you know, for years. And I bought a lot of investment property out west. People would refer to, you know, West Auckland or the Wild West or way out west, but Te Atatu South's 13 kilometres from Auckland CBD. You've got all that widening that's been going on the northwestern motorway for years now, and when you think about 13 k's to the CBD, there's great value on locations sort of like that. So look at the radius to the CBD, look at the radius to the major employment centres like Manukau, and then look at the last 10 years, look at the last 20 years in terms of those trends, in terms of growth rates and demand. Focus on the numbers, so we can help you with that as well. Pete's asked, I have capital available, so where should I start? Cash flow positive property, apartments in Christchurch or Wellington? I replied to Peter, I remember producing your property acquisition strategy report recently. So basically what I said to Peter is we can make recommendations, but we'll match it to your current investing profile. We'd never ever say, I'll go and buy this, because it all depends on the timing with entering that market. So clearly Christchurch has got more legs in it than Wellington for some obvious reasons. But also, with every portfolio, we work out your servicing for you on what do you need most. Are you able to borrow more right now based on income or more based on equity? If you're short of equity, then capital growth's a pretty key driver, and adding value like with the Tuam type project where you can add $40,000 of equity upfront by buying at a discount, that's a real driver. If you've got tons of equity but you need servicing next because of your income or because yields on other properties within your portfolio, then we'll help you match that to a higher yielding, higher cash flow type property. So it takes your servicing ratio forward. So on every chair or every stool, there's two legs. In this example, one's going to be a weak leg, one's going to be a strong leg. We're also always trying to work on how do we build up your weak leg so that it doesn't become an impediment later. Katsutaka has asked, how do you as a property factory make money if you're not a normal real estate agency? And so, yeah, as Campbell answered, we're a licensed real estate agency. We get paid fees on sale by the vendor, but essentially our service is free, but we're a buyer's agency focused business. We source and negotiate stock for our clients, our members who are our investors. And if we're lucky, we might have 1 in 10 projects that get through due diligence and make it to listing. Most of the time, it's more like 1 in 20 because the numbers don't stack up, the location doesn't stack up, it's too over-spec'd, it's owner-occupied focused, it's wrong timing, etc., etc. So that's our focus. Katsutaka has asked, do you believe all of your projects are at 6 to 8 o'clock? No. I mean, there's markets within markets, and absolutely, if you take Te Atatu South by way of example, despite Auckland's peaks and troughs as a whole, Te Atatu South just trucked along nicely year after year after year, decade after decade. So, you know, that's a good bread and butter suburb. If you take Wellington right now, some could argue that some parts of Wellington are getting on towards 9 or 10 o'clock, whereas we know Christchurch is at 6 o'clock in some locations and probably 7 to 8 o'clock already in other locations that are starting to move. So, you know, again, we have clients who are just quite determined to buy in some locations regardless of timing. But we'll always make sure the project stands on its own 2 feet in terms of the fundamentals, in terms of the long-term sustainability, in terms of population growth, rising prices, rising demand, increasing rents, and taking a long-term view of the growth history as well. Okay, so and then another question has come. So you essentially are working for buyers more than a normal real estate agency. Yeah, correct. I mean, we see ourselves as a buyer's agency or a buyer-centric business, and that is our focus in terms of what we do. So I had another question come through. I can't quite see the chat toolbar, but it was around where should I buy next, and what's the best deal for me in terms of growth and cash flow. And my answer is, you know, a normal real estate agent would say, buy this because we want to sell it. Our answer is, until we understand what your current position is, where your weaknesses in terms of equity or servicing, and where you want to go next, we wouldn't recommend anything. If you join up as a wholesale member, it's free. Log in quick, click on that property acquisition strategy button on the dashboard, which you can see on the screen right now. When you log in, of course, not on this screen. Just, you know, 6 bits of information will allow us to produce a report to give you an idea on where to next and where you're strong or where you're weak. And at that point, if you then want help, we'll then happily spend time at no cost to provide some recommendations about what's best for your portfolio, because it's all about not the next deal or the deal after that you do. It's about when you get to 3, 4, and 5, that you haven't run yourself down a dead end in terms of income or equity growth, and then left yourself at a point where you've got to sit on your hands for 2 or 3 years while you wait for incomes to rise or the market to move. So that's really the focus. It is a formula, and it's about the numbers, and there's always more than one good answer or one right answer as well. There's never just one answer. Campbell.
Yeah, I think you covered it off pretty well there, David. Look, these webinars, these events we've been doing around the country have really blown me away in terms of how many people are, you know, new investors getting into the market, people that have done really well in terms of paying off debt and creating equity, may have bought one property, but you can't retire off one property. And what you're doing now is actually what you're going to live off in 5, 7, 10 years' time, depending on your starting position. And we take that seriously. We literally look at your circumstance or your situation as if you were us, if we were you. And from a taking it serious perspective, if we have a lifetime view with our clients. If we're doing well by you, you will come back and buy property off us after property after property. And sometimes, depending on where the market's at, you know, we'll say, yeah, it's definitely time to buy one. But in places like Christchurch, where I mean, my clients that I'm working with, I've been in this market for a long time. They were paying $700 a metre for land. They're now paying $2,000. Same in Hamilton. Our developers in Hamilton are paying more for land significantly than they were 3, 4, 5 years ago. Well, that's the first sign of a price rise, because if the current developers are buying land at $2,000 a metre, well, the end house has to be more. They can't build it any cheaper. In fact, it'll be even more expensive to build the house as well as the land. So we have a whole bunch of drivers that we use to make these assumptions and make these predictions. It's not just pulling it out of a bucket. And so when we make a buying recommendation, we do it after a lot of consideration, and we get a lot of feedback and input from our partners. And you know, the banks are favouring new versus old. The financial advisors are saying, yeah, Christchurch makes sense. Rent on cost is good. Forecast values look higher than where they are. So we're not the only ones saying this stuff. And I guess when you meet some of our people that you will use, like our finance experts, our financial advisor experts, even our accountants and lawyers, they're property-centric professionals, because property is its own beast. And most people in the market, you know, they'll come into a windfall or an inheritance, they'll pay their home off and they'll buy a rental, and they will literally use very scary decision makers for where they buy. So if you look at our website and you go look at our property reports, we have done hours of research for you, and the arguments are all there. They're economical and accounting and legal, well, maybe mainly economical and financially driven decisions. It just, to us, just makes sense. And I guess we've been in the game long enough now that we've had clients that have doubled their property values and their rents now accelerating debt repayment. That this isn't all some great big theory. This is cycle number 5 for us. So, you know, I guess we know what we're doing, and would love to have you on as a client. So yeah, back to you, David, and I think we'll leave it on for a couple more minutes, unless there's some more questions. I do see some questions here. Hang on, before I hand over to you. So someone asked me, if you are buying in Hamilton and get a valuation 60K less than the developer's price, should you stay clear of it? Wow, that's a big difference. Now, I don't know if that's a $600,000 property or $1 million property, Melissa. But, valuations are hard, because if we got three valuers to value the same property, they're going to come up with three different numbers. So it's hard for me to comment on that. But most valuers that we've worked with in Hamilton are always pretty within coo of each other. But I can't comment on just knowing what that is. But feel free to give us an email, Melissa, and we'll give you our opinion. Someone's asking about platinum membership. Basically, platinum membership, it's $1,000 or I think it's $500. I'm not sure. David runs that side of the business. But basically, you get the platinum members get. It's like anything you pay for. It's like Cora membership. You get more benefits. One of those main benefits is that when we launch a new deal, like these 7 discounted properties on Chilton Street, they go to platinum members first. They have first dibs on. So, that's a significant advantage, because those ones have $40,000 discounts. So if you buy that off Harcourts tomorrow, you'll pay $40,000 more than if you buy it off us. And I call that a true wholesale discount. So, Pete, I hope that answers that one. And again, feel free to email us with more questions, because David could take. There's a lot of stuff in Platinum that you get as being part of a member. But our free membership's good too. Please join that, and at least fill out the information for your property acquisition strategy, because that's a really, really informative document that you'll understand more about your financial situation than you did before you filled it out. David, are you still with us?
Yeah. Did you see that question from Ryan on Whangarei and what your thoughts are on Whangarei?
Oh, here we go. I'm looking at, there's 2 chat boxes. Ryan, what's your thoughts on Whangarei? I used to live in the region. So I used to live in the Wairarapa, and I've done the whole country thing. I loved it. I'm really, really happy to be back in the city. And it's not a personal view. It's more about right now, we're getting cash flow positive deals in the cities. So as much as I love the regions, I don't see there's any reason to invest in a location with a small population pool when you can get a city like Christchurch with 500,000 people, or a city with Auckland, a city like Auckland with 2 million people, and invest in pockets where it's cash flow positive, brand new stock, 20% below the median. So I think in a year or 2 years' time, as prices go up, we will be in the regions. But we're in Central Otago, that's the regions. But Whangarei at the moment, we think the timing is a bit early. I don't think it's going to go down in price, but there are, in my opinion, more economically driven locations that make sense to invest in now. But look, yeah, we will be in the regions over the coming years. There's no question.
Okay, and just a couple of earlier questions from Saad around lots of properties for rent in Christchurch. So I was wondering what the average time to rent is for a new apartment. We've found if you work with the property managers leading up to the property becoming available, that average time to rent is less than 4 weeks in most projects. So it's about planning and preparing early, and being realistic about market rent at the time you go to get your tenant in, and then reviewing rents 6 to 12 months on as the market sort of settles down.
I'll just add to that, David. The last one I can remember was it was an 18-unit complex, but they were dual key, so that's 36 tenancies. And they were studios, which were about 25 square metres, and 1 bedrooms, which were about 40 square metres, 35 square metres. So really nice complex in Christchurch on the northeastern side of the 4ABS, inside the 4ABS. Anyway, the property managers had 18 tenants in less than 4 weeks. And what I'm hearing on the ground at the moment is that tenants are now a lot more aware of new than old, and they've got choice, and the rent isn't that much more. They are paying a premium for the new, but not a huge premium. So, I do not know any complexes in Christchurch, CBD, that are sitting there empty. I'm seeing property unsold, but I am not seeing properties empty when people buy them for rentals, or people are selling them to owner occupiers. So yes, there's a lot of stock coming on at the moment, and that stock is, in my opinion, not going to last price-wise, but it's not sitting empty. It's all rented, short-term furnished, long-term unfurnished, long-term furnished. We're seeing a real mix in the city at the moment.
And it's such a livable, walkable, cyclable, scootable city. It's, you know, as much as Melbourne's famous in Australia for its architecture, Christchurch is head and shoulders above that in terms of the look and feel of the city. Is, you know, and it's attracting people from the suburbs to the city from a lifestyle point of view. It really is quite a sight to see. So, you know, it's not just a normal situation in Christchurch with everything that's happening right now with infrastructure and, you know, all the livability of it.
Well, even go back up to the North Island, Te Wata, you know, those first 100 houses, 20 of them might be rentals, definitely 15. You know, that's not that many rentals in a location like that. And unfortunately, a big chunk of the market now rents. Now, it's good from being a landlord, but the reality is that people who have to rent, who's going to turn down a brand new 3-bedroom, 2-bathroom house over a second-hand, single-glazed, cold, uninsulated house? And that's the thing about new rentals. People aren't just moving to them because they're nice. They're moving them because they're economical and they're healthy. So, yeah, I think the paradigm shift has well and truly happened. And if you're in second-hand rentals, one of the things we will probably say to you, especially from Wellington, is seriously look at selling them, because people have bought properties for 300-400 grand years ago and they're now 800-900 grand. I don't think you're going to keep getting those sorts of gains with second-hand stock. I really don't. And a lot of Auckland clients are getting recommendations by us to sell and replace with, you're selling one old crappy rental, you're getting 2 brand new ones. And that's, to me, riding the market, so buying at 6 and selling at 12. But you're not selling, you're replacing it with 2 income streams and sometimes 3. You know, those Te Wata houses, 2 of those is same price as a pretty average house in Auckland. So I know where I'd rather get my rent from. Okay. David, have we got any more questions?
That's all that's come through. One earlier one on property management in Christchurch, and yeah, the costs are around 8%. But does vary. But the key thing is there are some specialist managers that manage furnished, unfurnished, and Airbnb type rental structures. And we've got a bunch of companies we recommend that are specialists. We're not property managers, but we can help recommend and refer to people that'll do a great job. And a good manager makes a massive difference to your rental income, but also to the satisfaction and happiness of your tenant.
Absolutely. All right, well, why don't we leave the screen on for a bit longer for a few more questions, David, and then we'll shut this down. We hope it was informative. And yeah, thanks for your questions that have answered. And Melissa, if you want to email me more details on that deal, I just can't make a comment on Hamilton and evaluation coming in less without more information. So it's just a hard one for me to answer. So if you could send us an email with a bit more detail, that'd be great.
That's great. That's great. Well, that's all the questions today. So if we don't have any more, thanks everybody for putting aside an hour and a half and, you know, take advantage of our service. Go sign up and let us know if we can help you put together a strategy report to help you figure out where to go next.
Cheers, everybody, and have a nice night.
Thanks, everybody. Thanks, Campbell.